Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what publicly traded companies want you to see and what they might be hiding. In this report, Thermon Group Holdings is giving us a peek behind the curtain of its operations ending the 30th of September 2025. And let me tell you, it is a packed report with some very interesting nuggets. Grab your coffee because we are about to decode this. Alright, so what is the big picture here for Thermon Group Holdings Incorporated? This is a company that makes industrial process heating and temperature control stuff, essentially helping big factories and industries run smoothly and safely. They are a global player, and this report covers their quarterly performance. Let us dive right into the numbers. On the balance sheet for the 30th of September 2025, we see their assets total about $778 million. That is a healthy number to start with, but where is the actual money? Their cash and cash equivalents seem to have dipped to about $29.7 million from about $39.5 million at the start of the fiscal year back in March. That is a notable decrease, but not necessarily a red flag on its own. Companies often spend cash on inventory or pay down debt. Their inventories, however, have jumped up quite a bit from $89 million to over $110 million. This could mean they are stocking up for future sales, which is good, or it could mean they are having trouble selling what they produce. We will keep an eye on that. Now let's look at what they owe people. Their accounts payable jumped significantly to $41.3 million from $31.1 million. This means they owe their suppliers more money. This is usually fine if they are getting better terms from their suppliers, which allows them to hold on to their own cash longer. But it is something to watch. Their long-term debt is also a significant figure, sitting at around $118 million. In terms of ownership, their common stock situation shows a slight decrease in outstanding shares from about 33.2 million to 32.8 million. This could be due to share repurchases, which is often a sign that a company believes its stock is undervalued. Moving on to the income statement for the 3 months ending the 30th of September 2025, sales were about $131.7 million. That is a decent increase from $114.6 million in the same period last year. That is a good 15% jump. And with those sales, their gross profit, which is what is left after paying for the making of their products, also went up nicely by 20% to about $61 million. This suggests they are either selling more efficiently or have managed to increase prices. However, their selling, general and administrative expenses, the costs of running the business like marketing and salaries, also went up by 14% to about $35.5 million. So while sales are growing, so are the costs to support that growth. The good news is that their income from operations, which shows how profitable the core business is, jumped a really impressive 42% to over $21 million. That is a strong signal that the company is becoming more efficient. And all of this translates down to the bottom line. Their net income, the final profit, was about $14.9 million for this quarter. That is a huge 58% increase compared to the same time last year. That is a really significant jump. Looking at the 6-month period, the story is similar. Sales were up 5% to just over $240 million. Gross profit went up by 8%, but again, selling, general and administrative expenses also saw a bump, up 9%. Interestingly, in the prior year, there was significant restructuring and other charges of $2.7 million. This year, that number is zero. This suggests they cleaned up some issues or completed a cost-cutting initiative last year. For the 6-month period, income from operations saw a healthy 15% increase to about $33.3 million. And the net income for the 6 months ended the 30th of September 2025 was about $23.5 million, a solid 31% increase year over year. These are good numbers showing growth and improved profitability in their core business. Let's dig a bit deeper into what is driving those sales. The company breaks down its revenue into things sold at a point in time, which is mostly their products, and revenues recognized over time, which are their larger projects involving engineering and installation. In the most recent quarter, point-in-time sales were about $93.5 million, up 13.6%. Project sales also grew by 18.1% to $38.2 million. The acquisition of Fati, an Italian company, added about $6.9 million in product sales this quarter. So the growth is broad-based, coming from both products and projects and boosted by acquisitions. Geographically, the United States and Latin America segments saw revenue rise 8.4%. Canada also grew by 9.6%, but Europe, Middle East and Africa, that part of the business absolutely doubled its revenue. That is largely thanks to the Fati acquisition we mentioned. Asia Pacific, however, saw a bit of a dip down 4.1%, attributed to ongoing global trade policy uncertainties, particularly with China. Now, about that fatty acquisition, it added about $268,000 to their goodwill. Goodwill in accounting terms basically represents the premium paid for an acquired company over its identifiable net assets. It is essentially the value of intangible things like brand reputation, customer loyalty, and skilled workforce. This acquisition seems to be integrated into their Europe, Middle East, and Africa segment. Looking at their debt, on the 24th of July 2025, they entered into a new credit agreement. This is quite significant. This new agreement provides them with a $115 million revolving credit facility, which is like a flexible loan they can draw on as needed, and a $125 million term loan. This secured facility is set to mature in July 2030. The funds were used to pay off old debt and for general corporate purposes. They are also subject to certain financial covenants, like maintaining a consolidated leverage ratio. As of the 30th of September 2025, they were in compliance with all these requirements. Let us talk about cash flow. For the 6 months ended the 30th of September 2025, their net cash provided by operating activities was about $18.1 million. That is down from about $21.2 million in the same period last year. This dip is mainly due to them investing more in working capital, especially building up inventory. They are preparing for the busy heating season and also stocking up on some materials before potential tariffs increase costs. Their free cash flow, which is operating cash flow minus cash spent on property and equipment, was $12.7 million this year compared to $15.4 million last year. So while they are generating cash, they are putting more back into the business. On the international front, foreign exchange rates had an impact. For the 6-month period, they saw gains of $12.1 million from translating their foreign assets and liabilities back into US dollars. This is largely due to the US dollar weakening against other currencies they operate in. Now, about market risks, their main worries are foreign exchange rates, interest rates, and commodity prices. Around 44% of their revenue comes from outside the US, so currency fluctuations are a big deal. They estimate that if the US dollar were to appreciate by 10% against the Canadian dollar, their net income could drop by about $1.4 million against the euro. A 10% appreciation could mean a $0.5 million hit to their net income. They do use foreign currency forward contracts to try and manage some of this risk. On the interest rate front, a significant portion of their debt is tied to variable rates, like the SOFR rate, with $125 million on their term loan and $14.7 million on their revolving credit facility. A 1% change in interest rates could mean about $1.4 million more or less in interest expense annually. That is a considerable sum. They also use commodity-based raw materials and usually do not hedge against price changes. This means they are exposed to price swings. They have seen shortages and price increases recently due to tariffs, freight costs, and longer lead times. They are not sure if they can always pass these costs onto their customers, which could hurt their profits. In terms of legal matters, Thermon states they are involved in various legal and administrative proceedings that arise in the normal course of business. They do not believe any of these will have a material adverse effect on their financial position. But they do acknowledge that charges related to these matters could be significant in any one reporting period. Going back to shareholders, they bought back about 236,000 shares in the quarter ending the 30th of September. 2025, this is part of a larger share repurchase program. They still have about $38.5 million available under this program. Buying back shares can be a good sign, showing management's confidence in the company's value and potentially increasing earnings per share for remaining shareholders. Finally, looking at the exhibits, one notable item is the second amended and restated credit agreement filed on the 24th of July 2025. This outlines how they are managing their debt going forward, which we touched upon earlier. The rest are certifications and standard filings. So, what is our take on this report? Thermon Group Holdings Incorporated seems to be on a solid growth trajectory for the most part. Their sales are up and, more importantly, their profitability from core operations is increasing significantly. The acquisition of Fatty appears to be a smart move, boosting revenue especially in their European operations. They are also managing their debt well and complying with their loan agreements. However, there are a few areas to watch. The increase in inventory and accounts payable needs to be monitored to ensure it leads to sales rather than production issues. Their exposure to foreign currency fluctuations and commodity price volatility presents a constant risk, especially with ongoing global trade uncertainties. While they are growing, they are also increasing their expenses, so maintaining that profit margin growth will be key. The increased interest rates on their debt could also become a concern if rates continue to climb. Overall, Thermon looks like a company moving in the right direction, capitalizing on growth opportunities and improving operational efficiency. They are a solid player in a critical industrial sector. We will be keeping a close eye on how they navigate those international trade headwinds and manage their debt costs in the coming quarters. Alright, that is our deep dive into Thermon Group Holdings Incorporated latest quarterly report. Where do you stand on their performance and future prospects? Let us know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe to Corporate Decoder for more in-depth analyses like this. Don't forget to join our Discord community. Details are in the description below to continue the conversation. Thanks for watching and well, see you next time.